In a world where financial markets can swing wildly on the hint of a single word, Federal Reserve Chair Jerome Powell's recent address at Jackson Hole has sparked both excitement and unease. While his speech reassured investors that interest rate cuts may be on the horizon, some market participants are approaching this news with caution. Why? Because lurking beneath the surface is a growing concern. Could the U.S. economy be heading towards stagflation, a toxic mix of sluggish growth and stubborn inflation? And this is the part most people miss. Enthusiasm for rate cuts might be masking deeper vulnerabilities. Powell's remarks, delivered as part of his final appearance at the prestigious Jackson Hole Economic Symposium, hinted strongly at a potential September rate cut. However, he stopped short of making any firm commitments, instead striking a delicate balance between addressing labor market concerns and managing lingering fears about inflation. This cautious tone reflects the tightrope the Fed must walk, responding to economic data without succumbing to political pressure. Speaking of which, there's an elephant in the room here. The White House has been vocal about wanting easier monetary policy. Could this influence lead to overly aggressive rate cuts down the line? It's a question worth asking. For now, though, traders and investors seem to be taking Powell's comments as a green light. Following the speech, Treasury yields fell sharply and stocks surged higher. The Dow Jones Industrial Average even hit a record closing high, while small-cap stocks and housing-related shares saw significant gains. Rate-sensitive sectors like these tend to thrive when borrowing costs decrease, so it's no surprise they led the charge. But here's the catch. Will this rally last if broader economic conditions don't improve? While the immediate reaction is positive, said Matthew Miskin, co-chief investment strategist at Manulife John Hancock Investments, what happens after September remains uncertain. His words echo a sentiment shared by many seasoned analysts that markets may be getting ahead of themselves. After all, upcoming data on inflation and employment could easily shift expectations again. If job growth continues to falter, or inflation proves stickier than anticipated, the Fed's ability to support the economy through substantial rate cuts could be severely constrained. This brings us to another critical point: stagflation risks. Drew Mattis, chief market strategist at MetLife Investment Management, warns that the combination of weak growth and persistent inflation poses a serious challenge. People have started to worry we're entering a stagflationary environment, he explained. While Mattis believes some level of economic growth is still achievable, he cautions that it won't feel robust enough to offset inflationary pressures. We'll likely see some growth, he noted, but it won't exactly inspire confidence. Adding fuel to the fire is the issue of Federal Reserve independence. Powell reiterated during his speech that monetary policy decisions will remain strictly data-driven. Yet, recent actions by former President Donald Trump, who called for the resignation of Fed Governor Lisa Cook over mortgage-related allegations, have raised eyebrows. Critics argue that such moves threaten the central bank's autonomy, potentially undermining its credibility. Trump's comments on Cook are reigniting concerns about the Fed's independence, said Helen Given, director of trading at Monex USA. The implications of this tension extend beyond domestic borders. A dovish Fed often weakens the U.S. dollar as lower interest rates reduce its appeal to global investors seeking higher returns elsewhere. Indeed, following Powell's speech, the dollar index dropped sharply against major currencies like the yen and euro. Carl Shimada, chief market strategist at Corpay, pointed out that rate differentials are tilting against the dollar, prompting traders to position themselves for opportunities outside the United States. So, what does all this mean for everyday investors and businesses? On one hand, looser monetary policy can provide much-needed relief for borrowers and stimulate certain sectors of the economy. On the other hand, Overly optimistic assumptions about future rate cuts could set the stage for disappointment if underlying economic fundamentals fail to improve. As Tom Graff, Chief Investment Officer at Facet, put it, rate cuts alone won't sustain stock market strength if the economy stalls further. But here's where it gets controversial. Should the Fed prioritize short-term market stability over long-term economic health? Is it wise to cut rates aggressively amid inflationary pressures? These questions aren't just academic. They go to the heart of how central banks should operate in uncertain times. What do you think? Do you agree with those who believe the Fed is doing the right thing? Or do you side with skeptics who fear the consequences of premature easing? Share your thoughts in the comments below. We'd love to hear from you.